Welcome back, investors, to Ticker Time News. I'm Adam, and inverse head and shoulders, cup and handle, or evening star. Which chart pattern has the best odds of playing out? We're going to dive into all three and pick one, and which one is it going to be? Also, the most important thing, answering your questions, we're going to do as well. So if you have a question, put it into the live chat and we will go over it live during the show. Welcome back again, investors. I'm glad you're joining your day with me, at least a part of your day with me. I greatly appreciate it. You are awesome. Now, today, okay, it looks like the stock market had a case of the Mondays as the day started off with a bit of a spring in its step, but by lunchtime, sentiment did a 180. In the main indices, closed with a loss of at least 1.3%. The S&P 500, ticker SPX, and the SPY were both down 1.6%. The Qs were down 1.3%. The Dow Jones was down 1.8%, and the IWM, your small caps, were down 1.6%. It was just a big down day for the markets. It's one that we've been talking about literally for about 4 sessions in a row now, that this was going to happen, that we were going to get this pullback, that the 2022 resistance, that resistance line, that downsloping trend line that has stopped every major rally in 2023 and now in 2022 and now in 2023 is a tough trend line to break. You can see it started back here January the 3rd of 2022, and now over a year later it has put a stop to this rally. This is an extreme downsloping trend line. I mean, we have 1, 2, 3, 4, 5, 6 encounters with this trend line, and all 6, we are 6 for 6 right now of this downsloping trend line stopping rallies. It's a monster, and it's kind of tough to believe that this thing has held up so gosh darn well, but it has. And well, let's get back to what's happening with the market today, and why by lunchtime were we doing a 180 a 180 on the chart. I just want to get this, hold on, I need to get this cleaned off the chart. It makes it a little messy here. Am I getting it? I think so. There we go. Okay, yep, just had a couple extra lines on there I didn't want to have. Let's open this up. I want to take this and go real quick. Let me open it. Let's open it. All right, as far as where could the support be for this thing as it's pulling down, I mean, this was a big move down and a big rejection off of the downsloping trend line right here. We're going to talk about it, but we have this ascending, turning flat, anchored VWAP. This is anchored to the first trading day of 2023, which was January the 3rd. It would also take into account the first trading day of the month of January and the first trading day of Q1. So that'll be a very important anchored VWAP. So we have that one coming up. We also have the 50-day moving average. Both of those are converging, all right? So I think those two areas would be important to watch. Right now, the 50-day moving average is currently sitting at 39.23. And the anchored VWAP is right below it at about 39.17. So let's just call a nice round even number, 39.20. Let's watch out for support at 39.20. Can we get that? If not, then, well, we could break down even further And we have another anchored VWAP that's right down here that has converged with the, what would this be? This would be the 20-day moving average that it has converged with. So those would be like the two main support areas I'd be looking for. And I want to point out one more thing on this chart before we dive in a little further. Let me open this up. We closed and there is a gap right underneath of us. This is very important to understand, okay? So we basically closed at the low of this candle right here, all right? This candle here. We closed at the low of that candle, which is 39.28. If we fill the gap that was set in between the closing of this candle and then the very next day opening of, that candle there beside it, that gap right between the two right here, that gap needs to get filled in. So the top of the other candle, let me clean this up now. So the top of this candle right here, it closed at 39.19. Remember, I said 39.20. Let's give us a nice round number to remember. 39.19 is where this candle finished on the day, and then we gapped up to the next candle, creating that gap. And, gaps get filled. And here we are closing right above that gap. We could very easily fill that gap, go down to 120, maybe bounce around in between that anchored VWAP, which is the month to date, year to date, and quarter to date anchored VWAP, or the 50-day moving average, somewhere in between them, like 39.20. And since we are below the lower end of the weekly expected move, which is currently sitting at 39.37, well, technically we are 1 point. Then if we do go down to fill that gap and then bounce somewhere between those two trend lines, say 39.20, then by Friday we could bounce right back up and finish the week within the weekly expected move. That's a possibility. That's one that I'm looking for, okay? That's one that I'm looking for, because 68% of the time it does close within the weekly expected moves. And we are just 1 point off of that weekly expected move, okay? All right. We did that. Now let's go into the a deeper time frame here. I'm going to go to the 15-minute, and I want to adjust the 5-day moving average. I want to adjust that so we can get a fix on where we are. All right, let's pull this back down. It was a pretty far fall today, a pretty big move today. All right, let's get the past 2 days on here. Maybe the past 3 days so we can really see. Okay, so here's the past 3 trading sessions in a row here. You can see we were on this nice kind of move up. We got to our resistance line. We held kind of right there, bouncing slightly above it, for a few minutes at a time, but really nothing significant yesterday. And then this morning, we completely gapped up over that trend line. We gapped up over that trend line right there. And I don't know why my Sharpie is not staying on. But anyways, you get the hint. We gapped all the way up over that trend line, but we didn't hold it there. It seems like the growth concerns that we thought were on the back burner, at least at the start of 2023, have come back to haunt us. Because initially with the S&P 500, it was feeling pretty good this morning, back above that 4,000 level. thanks to some optimism about the slowdown in inflation as reflected in the December producer price index, with the final demand decreasing 0.5% month over month. The expectation was only 0.1%, so that looks better. Now, core PPI, or producer price index, you take out the food, you take out the energy, and that increased by 0.1% month over month. Now, on the year over year numbers, the PPI was up 6.2% versus the revised 7.3% in November. And core PPI, again, take out food, take out energy, and it was up 5.5% versus 6.2% in November. So what's the takeaway here from the PPI report, or the producer price index? Well, I think the takeaway is that while it showed the desired slowdown in the year over year headline and core PPI numbers, the absolute levels remain high. So the market will want to see a continuation of this trend in the coming months. Now, as it turns out, that optimism from the PPI report was short-lived. Investors soon realized that the weak retail sales and manufacturing data from December, combined with the Fed's likelihood to remain higher for longer, they were not pleasing, as the PPI report had led them to believe. See, total retail sales fell 1.1% month over month in December, and industrial production decreased 0.7% month over month in December, which didn't exactly have the market jumping for joy. The key takeaway, though, is that the sales in most discretionary categories fell for the second month in a row. The department store sales, they were diving. They dove 6.6% after falling 3.2% in November. Now, to add insult to injury, then we had Fed speak, okay? Now, you can see the big decline this morning, and then we tried to kind of hold ourselves together right around this level here at 39.40. 39.40 to 39.45, that was an important area. I sent a note out on Tuesday to our private investor community, specifically calling out 30.40 to 30.45, thinking, there could be a chance there, and it's a number, a level that needed to be watched. We tried it, but at the very end of the day, we really broke down from that level. And of course, with the weekly expected move at 39.37, that was another reason we bounced right there at that. Couldn't hold it, though, at the end of the day. Now, maybe Fed speak had something to do with that, because the St. Louis Fed president said he would prefer that the Fed stay on a more aggressive rate hike path, right? He would like to be aggressive with taking rates up still. And then we had the San Francisco Fed president. And the San Francisco Fed president said the February rate hike could either be 25 or 50 basis points. Now, the CME Fed Watch tool practically remained unchanged, with the probability, and I say that this unchanged, and I'm putting a big emphasis on that word unchanged, because Fed speaks saying, oh, wait a minute, we could get a 25 or a 50 basis point rate hike. You may think that the CME Fed Watch tool, maybe that probability shifted a little bit and brought that 25 basis point rate hike down, but it didn't. It remained practically unchanged. It moved like 0.1%. So right now, the probability of a 25 basis point increase sits at 94.8% for the February 1st FOMC meeting. And you can look that up and Google it too. Just open up your search engine, whatever you want to do there. Type in CME Fed Watch Tool. I do it so often. It's autofills for me. First link, CME Group. This is where you want to go, okay? And this is going to show you the probabilities. They've got a countdown clock up here for the next Fed meeting. And there's actually a lot of good information on here. But look at this. Actually, look at this. Since the time that I looked up this number to right now, and I guess I looked this number up probably about 5 p.m. Eastern. So we've got a few hours difference here, but it's gone up even higher for a 25 basis point rate hike. I had 94.8% written down. It's up to 96.4% of a probability of a 25 basis rate hike on February the 1st. So it's actually gone up higher, even though we had Fed speak today trying to throw out a curveball to us, mentioning that, maybe it could go to a 50 basis point rate hike. Maybe, 25, 50. We'll see where we are. But the market is saying, no way. We don't believe that Fed speak. Because the probability went up higher on the 25 basis point rate hike and went down lower on the 75 basis point rate hike. There's barely a reading over here for the a 50 basis point rate hike. I'm just so excited about this. It's down to a 3.6% probability of a 50 basis point rate hike. It's dropped down. Even though Fed speak today kind of said, hey, we're going to throw the market a curveball. And I know why. Jerome Powell does not want to see this market rally. Jerome Powell does not want to see this market front run a potential, and I'll put it in quotation marks, a Fed pivot. We're not getting a Fed pivot anytime soon. We will get a Fed pause either this month at this meeting or the next meeting. So we either have one or two rate hikes left at 25 basis points. That's what's in my investment thesis for this market right now. One or two, either February or March, will be the last rate hike. And then the Fed will hold it. And the Fed will hold it all the way until fall. And then we'll start getting some chatter about, okay, how's the economy holding up? How did it do over the summer? Should we start talking about bringing the rates back down? Looking at the MBA mortgage application index, that thing shot up over 25% this past week. People were getting mortgages, and they actually the percentage went more to those who were refinancing their mortgages. So that's interesting to me for the housing market. So I'm not going to get into the housing market too much, but I do think that was a very interesting move. Okay. Now, market participants did receive a little more commentary from the Feds today, besides Fed speak. This afternoon, we did get the FOMC release of their beige book, and it came out at 2 p.m. Eastern. And if we're looking at the chart here for, any type of reaction to that, there really wasn't any. 2 p.m. on the chart was, let's see, where is it? There's 12, there's 1, 14. Where are you? See, 14, it came in right here. 2 o'clock p.m. Eastern. This is when the FOMC beige book was released. And the market just continued to move sideways, and it was shortly after that that the market sold off into the close. All right, going and closing right underneath, 1 point below the lower end of the weekly expected move. And I do have the numbers for the expected move for tomorrow, for the single day tomorrow. But that's the lower end of the weekly expected move. I'll look those numbers up when we're getting closer to the end here. Now, in that beige book, there wasn't much of anything new, right? On balance, contracts generally expected little growth in the months ahead, which isn't so good for our economy. Now, let me go back to the daily view here. And before I go through the main indices, let me just point out a couple of other interesting, fascinating numbers here that I saw take place in the market today. One thing, while we are here, volume was up a little bit higher than yesterday on this bigger move down. That was noticeable. It was over a declining moving average, meaning volume popped up above a moving average that was declining. So that was good to see more volume pick up. Now, treasury yields. That's what I want to talk about, because treasury yields, they took a noticeable turn lower today. But the drop in the market rates was not supportive for stocks. And the reason why, it was a manifestation of concerns about weaker growth, which in turn should lead to lowering earnings estimates. They are still too high. Let's start with the 2-year, the 2-year yield. Look at this big red candle that was created today. Obviously, when I have them blown up like this, they look a bit more severe than potentially were. But over the past several sessions, we were in this symmetrical triangle type shape, which is neutral. A symmetrical triangle, you can go up, you can go down. It's neutral. Well, the 2-year went down today. It actually dropped 11 basis points to close at 4.09%. In the after hours, it's down another 0.2%. That's interesting, right? What is the 2-year more sensitive to? The 2-year is more sensitive to the Fed funds rate. So if the Fed funds rate is going to change up or down, it affects the 2-year yield. Now, if you're asking me, the 2-year, it really didn't break anything from where it's at. It's at an area of support. Really, for this thing to go down, we would need to have this 2-year close under this absolute low. Let me get that highlighter again. Right here. If it broke that low, which is 3.99%, basically getting under 4%, that to me would be significant for the 2-year. All right, let's head over to the 10-year yield. Now, the 10-year yield fell 16 basis points. Now, with the 2-year going down 11 basis points and the 10-year going down 16 basis points, we're still inverted, right? Because the 2-year is, let's call it 4.1%, while the 10-year is at 3.3%. So that yield curve is still inverted. However, with the 2-year falling 11 and the 10-year falling 16, that rate of inversion did close the gap just a little bit today by 5 basis points. That is a positive, and it would really be a positive for banks if we could get out of this yield curve inversion. But anyways, back to the 10-year. The 10-year, this is again an interesting place. If it broke, and we've got the 200-day moving average coming up like this, if it broke that 200-day moving average, I think then the 10-year yield could fall much, much further. I mean, this was a big fall today for the 10-year. And what is the 10-year more sensitive to? The 10-year is more sensitive to growth concerns and inflation. And we heard about both today. We heard about inflation getting a little bit better through the PPI, and we heard about inflation getting a little bit worse through the retail sales report. I'm sorry, growth concerns getting a little bit worse through the retail sales report, and inflation getting a little bit better through the PPI. Okay, so the 10-year here, you know, it's at a point, it's real close to that 200-day. Where does that sit at? It sits at 3.33%. We are right this moment at 3.37%. It closed today at 3.38%. So we're not that far off. 3.33% is where that 200-day moving average is. Now, that could act as support, giving a little bit of leverage back to the 10-year to send it up a little higher. But it is coming very, very close, and I think it will come in to contact. Now, today's selling effort, it had the S&P take out its support at its own 200-day moving average, which was at 39.75. And we're going to look at that a little bit closer. But before I go back to that chart, let me go to the dollar. Let me show you what the dollar did today, because that's important. The dollar basically went nowhere. It basically went nowhere, okay? Let me pull this up a little bit higher so you can see it and open it up some more. Remember, my number was 102.5. That was like my, you know what, if it breaks it, that's my line in the sand, and it broke it. Now, since breaking it, only one of the days since breaking below 102.5 has it actually closed above 102.5, and it was 102.55, and that was on Monday, January 16th. So just a few sessions ago, that's where it was. Now, really, since it's broken through, it's been holding that 102.5 as a resistance line that it can't get back above. And that's why this was my line in the sand. Can the dollar get back above? Is the inverse correlation between the dollar and the SPY going to hold? Because all through practically all through 22, you know, January and a little bit of February, it didn't have that negative correlation. But for the remainder of 2022, it had that inverse correlation, the dollar and the SPY. If the dollar went up, the SPY went down. If the dollar went down, the SPY went up. We watched it practically all last year. And there's been a couple of instances so far in 2023 where it seems to have, it's like it's broke a little bit. Okay, it's broke a little bit, and we could see that correlation go out the window, and then it start moving in confluence with each other. That could be what's ahead, because as we go into a potential recession, then we could see the dollar weaken even more. Okay, and also equities then go down too. All right, let me go back. I'm gonna put the SPY SPX up here real quick to talk about the inverse head and shoulders, which I've shown you before, the cup and handle, and the evening star. Which chart pattern do you think is going to win out? But first, Junk Master, I should have got to you earlier. Missed out on a lot, and I mean a lot, of gains today in Deer. But as the rule goes, plan your trade and trade your plan. Amen to that one. That is true. Let me throw deer up here on the chart. And let's see. Oh, yeah. Look. Look, look, look. Look, look, look. Man. So the highlighter, I've left it there on purpose because I want to see how close, you know, deer could possibly follow this. It broke some significant trend lines today. That's for sure. I got to remove that one trend line. That one doesn't count. Broke below that 50, broke below that 20. That's just incredible. That's just incredible. How to do with the zones? Right back down just under midway with the zones. Okay, that's pretty cool. Yeah, I can see why you would say that. This what at 2.8%. That was. I'm curious. Caterpillar. Cat's been going to new all-time highs. I wonder if it followed deer today. It was red, 1.3%. Not as big of a move, but I mean, this thing's coming off a big old high from yesterday. I can't believe this thing. It's just been shocking how Caterpillar has been on the move up. What's the RSI? 70.8. Where's deer as far as RSI go? Deer's right in the midway, 54. So the relative strength, it's still strong. It is pointing down. So breaking that 50, right? That was an important move today. Let's see here. Also, Junkmaster, I'm thinking and hoping we get another rally to 400 plus before waterfall. Today's movement was a rotation out of industrials into tech. All right, let's put the SPY up here. I can show you those 3 chart patterns using either ticker SPX or SPY. As you guys know, I love using SPX because there's more liquidity that goes through ticker SPX over SPY. And when you're charting, you want that liquidity, because the more liquidity there is, the higher and more accurate your charts become. Okay, let's talk about the 3 chart patterns right quick. I showed you the inverse head and shoulders, and we talked about it. So we have the left shoulder basically right there. We had, you know, the head right there. We had the right shoulder right here, right? And then we had, I know my line's not perfect, and we had a shoulder running through right there, right? And on an inverse head and shoulder, you measure from the neckline to the top of the head, and that percentage right there, whatever that percentage works out to be, just a real quick back of the napkin math here, we got about 8% difference right there. That would be your target range for the breakout from breakout from the neckline, and it would go up 8%, and that's where your target profit would be, right? For this particular chart pattern. Now, the question is, since we had the big pullback today, the big breakdown from resistance, from the downsloping trend line, the resistance line, Does that mean that the inverse head and shoulders pattern is now invalid? Is it now invalid because of the breakdown we had today? That's the question, right? I think your answer could very well be yes. Sometimes, and this is a good example of that, sometimes when you have a chart pattern, it doesn't work out. And that's okay, because you need more than just one chart pattern. You can have a chart pattern, but then you need at least two other indicators of some kind that align with your chart pattern. And then, and only then, can you move forward with that trading strategy. Okay? All right. So head and shoulders, it's potentially invalid right now. Okay? Potentially invalid. Now, what about the cup and handle? Well, cup and handle. Let's show you this. We have what has formed right here, a bit of a cup, right? You can see that, right? So a cup and handle, and I should back up, the inverse head and shoulders or the head and shoulders pattern, they are bottoming and topping patterns, okay? An inverse head and shoulders, like we have on the chart that I just showed you where the shoulders, head, neckline are, that typically means that we've reached a bottom, right? And then we're going to start moving up higher. A normal head and shoulders that, you know, you've got your shoulder, your head's up a little bit higher, and then you have your right shoulder and then your neckline. That means we've reached a top and now we're curling over and we're about to head down. Okay? That's the difference between the normal head and shoulders versus an inverse head and shoulders. But they're both either a topping pattern or a bottom pattern. The cup and handle is a continuation pattern, and it can be bullish. You can also have an inverse cup and handle pattern, which would be bearish. We could potentially be having a bullish cup and handle pattern forming. We have the cup. Where's the handle? Well, typically you have a flagging pattern, okay? And that turns out to be your handle for your cup. All right? So you typically have this flagging pattern. It's usually kind of like a downtrend. And then you get your breakout from that, okay? And you measure it kind of the same way. The top of the cup down to the bottom of the cup or the bowl, and then from your breakout point up, that is, it should be equal to your top of your cup down to the bottom of the cup, okay? And that's how this chart pattern works. All right, it's a continuation pattern. Typically you're in a rally, you get the little cup part forming as like a slight little pullback or consolidation for the chart pattern, and then you get another little rally, and then you start forming your handle, and then you get a breakout from that. So the pattern is characterized by a cup shape, all right, that is formed by a downward trend followed by a period of consolidation, okay? The consolidation, right, we had our downturn here, we had our consolidation right here, which was the bottom of the cup, okay? And then we had a move up, right? Our move up. And now we're going to flag from that move up, have a flagging pattern. And that flagging pattern is the handle of the cup. And the handle part is a smaller downward trend that forms after the cup and is typically followed by a breakout to the upside. Now, the breakout point is the point where the handle meets the cup. So it would be right here, which is the top of the cup again. And then we get this right here, this measurement here from the top of the cup to the bottom bowl basin part of the cup. That's where we would measure to go up, okay? Now, it's considered a buy point once it breaks out from this point right here. That's where you would buy it and you'd ride it up to your target. Now, once the price does break above the resistance level formed by the handle, it's indicating a bullish trend. And traders believe that the stock will continue to rise. We're in a little different setting here, but the reason the cup and handle is even here is because we've been rallying. We had this nice rally from mid-October till the beginning of December. And then the month of December, we formed the cup part, and the beginning of January. And now maybe we're starting to flag to get the handle part. And then boom, it's a continuation from our turnaround in mid-October like this, right? That would be the continuation pattern, continuing from, over here in this area. Now then to continue over here in this area. All right, I'm just trying to explain these the best that I can to help you understand what they are. But remember, you always need more than just a chart pattern. You need two other pieces of data to go with the chart pattern, like either a divergence or convergence with an RSI or a MACD or a PMO or some other indicator, two other indicators, or a piece of data that's not related to chart. Those all are worth having. And that's what sets the chart up here for you. Now, yep, I see you there. It is quiet in the chat tonight. I'm noticing that. That's all right. Sometimes people just want to sit back, listen, and take in some knowledge. That's wonderful. I will talk about Bed Bath & Beyond. That thing is a monster. A bankrupt company. Maybe it's a zombie company at this point, but who knows? Maybe it turns into an AMC type story. I have no idea. But I'll go to the chart. We'll talk about it. I want to talk about the evening star next. All right. This is a 3-bar bearish reversal candlestick pattern. And the name of it is evening star. Let's go through the characteristics and see if we've got it. All right. First, I want to go here. The 3-bar bearish reversal. Now, we're looking at the past 3 candlesticks. The body of the candle, the wick of the candle. We're looking at the whole candlestick. All right. So an evening star, first off, you see there's 4 different patterns here. Okay. For the evening star, it doesn't matter which one you're using. Okay. You can see the main point here is the candle in the middle candle. Okay. that middle candle is the one that can have different forms. All right. That was, I don't even know why I drew those arrows. That was pointless. You can tell there are 4 different sets of candles. Now, first, the first candle needs to be a large bullish body. Let's go check. 1, 2, 3 candles ago, which will be this candle right here, we've got a large bullish body. Okay, we can see that clear as day. There's not much wick on the top or the bottom. And let's make this bigger so you can see it with me here clearly, at least as clearly as possible. All right, we're only looking at the last 3 candles. Today's candle, okay, these 3 candles right here. And I'll just do this at the bottom too. All right, those 3 candles. So candle number 1 is the one on the left here. Big green body. That's what we want to see. All right. So check 1 for the first candle. Now the second candle, it needs to open higher. It can gap up and it forms a small body. And you can see the 4 examples here. Okay. As it says in this description, the second, I'll add candle here, can have many variations: red body, green body, doji, hammer, hangman. That shape, it can be very broad, okay? But it needs to be a small body. What do we have? It looks like a spinning top candle, potentially a doji candle. We have a very small body. All right. Okay. So candle number 2, check. All right. Candle number 3, it closes deeply into the first candle. Let's look and see. And it does. If you look at today's candle, I'll put a dot here. This is where that candle closed. And you can see that today's candle, it took up and it basically engulfed that first candle. It overtook that candle. It opened up higher than that candle closed, and then it closed significantly underneath that candle. So this is considered an evening star 3-bar candlestick pattern, and it is very bearish. So we have the inverse head and shoulders pattern, which may have been invalidated with today's move, maybe not. Then we have the cup and handle. We're going in to form the handle right now. Those 2 patterns are bullish on the stock chart. The evening star candle is bearish, and it's the only bearish one out of the 3. So, what do you think? Just these 3 chart patterns. We're not taking into account anything else. Like, for example, we're not taking into account that today's volume was above the median. Our RSI, it is powerful. It is strong right now. MACD is still up with momentum. So we're not going to include any of those three things I just mentioned. Volume, RSI, or MACD. Only those three chart patterns. The inverse head and shoulders, the cup and handle, and the evening star. Which one do you think will play out in the market? Which one? You got two bullish choices. You got one bearish choice. Let me know in the comments which one you think it's going to be. I'll withhold what I think. I'll tell you tomorrow. But I think you probably know what I think. Oh, boy. Okay. Looking here on the SPY. I do want to point out two things. We got the weekly expected move, right? Right there. The lower end of the weekly expected move is at 391, and we closed at 391. The 50-day moving average is at 391. So the SPY closed right on its 50-day moving average. Interesting. And then we have the knowledge that says, okay, typically when an equity closes outside of its weekly expected move, it typically moves back inside. So, are we going down further tomorrow? Because we could. Or are we at a point in time where we're going to hold? Where maybe we're going to be green tomorrow and get back above the lower end of the weekly expected move. Okay. All right. I just added the anchored VWAP here. That's why a black line just appeared right here around 389, 390. That is the month to date, the year to date, and the quarter to date anchored VWAP. All right. Here's what I think, ladies and gentlemen. We hit resistance. We hit it hard. And we got rejected. We just came off of this big expansion move. Expansion, and I can go back here to demonstrate it. Expansion leads to contraction. Contraction is where we're basically not going anywhere. Contraction leads to expansion, which we just got done doing. And now I think we're just going to lead to contraction. Okay. Expansion to contraction, contraction to expansion, expansion to contraction. All right. That's what I'm thinking we're going to do next. We're going to move sideways. We're going to let earnings play out. We're going to let the economic data roll in. And, we could come down to this level where on the SPY, we've got the 20-day moving average. We've got the anchored VWAP to the low of 2022, which was October 13th. Or, we could come down just like on the ticker SPX, somewhere between the 50 and the month to date, quarter to date, year to date anchored VWAP for 23. And then we've got the downsloping trend line, and you know, maybe this levels out, and then we're in a declining triangle here, or decreasing triangle, whatever you want to call it, where we put ourselves in this little box here to consolidate. And then at some point, price is going to tighten, and then we're going to go for another expansion move. And it's either up or down. Okay. So that's where I think we are. We're in the stage of the game where we're going to start contracting now, because that's the cycle: expansion, contraction, expansion, over and over and over. Now, at some times, you can have an expansion move where your contraction literally lasts a couple days and then you expand again. We saw that in 2022. That can play out. The likelihood or probability isn't as high, though. All right, let's go to BBY, but I want to put this up here. Hey, y'all, how's it going? We back to bearish or not so soon? I think not so soon. I think we need to contract a little bit, because those, like I said, expansion leads to contraction, leads to expansion, leads to contraction. Punch that like button if you like Adam's insight. Well, thank you. Do click that like button. It does help the channel. Also, sharing the video with a friend, that also helps out greatly. Just share it on your social media. It takes just a couple seconds. That also helps the channel out. I'd greatly appreciate that as well. Okay. First up here, BBY. I didn't forget about you. And then I'll get back to the Qs, DIA, and IWM. Okay. Triple B. Why? This one is a crazy rally, collapse, momentum stock. This one goes through its phases. And this is a company that is potentially going bankrupt, potentially turning into a zombie company. And they are looking for investors to help them. And I don't know if they have found the investors yet, to help them go through bankruptcy and then come out on the other side as a healthier company. But of course, the retail world gets attached to this thing. It's up 68.6%. And then the next day, it's up another 50%. And then the day before, it was up 27. This thing moves like crazy. We got a down day of 30%, another up day of 13, a down day of 4. It's starting to slow down, okay? With the short squeezes, okay, we go through periods of time where the short open interest, it starts to build. Investors see a company that is going bankrupt, maybe cash flow is not there, maybe it's a profitless company, profitless startup, and right now, the company is just squeezing to get by. Well, once the scale's been tipped, you can get a short squeeze. And a short squeeze, like you've heard me say before, it's not a one and done thing. It can happen multiple times. It's a process. Once the short squeeze occurs, it can last a day or two. It can last a week. There's no set time frame for how long it's supposed to last. And the stock basically shoots way up real fast, and as fast as it goes up, it crumbles and falls back down. That's typical. Just like holding a lemon, you've cut that lemon in half, you're trying to squeeze out all that juice. You get down to the last drop, you can't squeeze it anymore. Same thing when a short squeeze occurs on a company like this. Investors start jumping in, they start chasing this thing, pushing it higher, and the short squeeze is just amplifying. Or maybe it is the FOMO amplifying the short squeeze. In any case, it gets amplified and over amplified. Then the short squeeze is over. It comes back down. And it can come back down just as hard as it went up. Okay? And then it'll get to a point where it kind of stabilizes. And then you start to see a slow drip, 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 where now it's going lower and lower and lower. I mean, if we just go back and look at some of the history before the squeeze took place, I mean, it was just a steady drip, 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 drip of this thing going down lower, down lower, down lower, until the excitement got so intense that the stock got over shorted. It popped. It's kind of like what's that one TV show, the Mr. Pimple, Dr. Pimple Popper or something like that. I don't know. That's your short squeeze. It seems like a one and done thing. It's a process that takes place. The difference is once the short squeeze is over, just like you can go and grab that other half of a lemon and start squeezing the juice out of the other half, the company, the stock, can go back through the process of having the stock being shorted again, and then it gets to that tipping point again, and it all starts all over again. This is a company that I would stay away from. This, to me, looks like a gamble. Now, sure, one way to look at this thing is a bigger view. And you can see this thing goes through these phases. It's nothing new. I mean, this was a huge phase back here when it ran up. I mean, just absolutely insane at the numbers back there. But it eventually it comes back down again just as hard as it went up, and then drip, drip, drip all the way down. Okay, so this is not one that I would even come close to putting any money into. You may think it's tempting that since this has run up, right? Since it has moved higher, and let me just show you this perspective right here. Let's bring this up a little bit more. Come on. The low right here, that was January 6th. The low was $1.27. It's at 3.94 right now. You may think that, well, since it ran up, maybe now's a good time to short this thing. It could be, but just go back and look at the history of this thing. Even once it's run up, and you know this thing, it can't stay elevated, especially going through a recession. You just have to look back at the history of this thing, and you may thought that, you know what, back here, not just maybe 5 months ago, when it was up here at, I don't know, $15, $14 a share, maybe then was a nice time to short this thing. But then it shot up and went even higher. Goodness, how high did it eventually go? All the way up here to like $20, $30 a share. So that would have been real ugly on a short if you tried to do that. So take it or leave it, but I would stay away. I'd leave it alone. That's my take on it. Now, I'm not looking at any of the fundamentals for the company. I'm just strictly talking about the movements, the momentum, the interest of this particular stock. It moves too erratically. All right. I know that's not exactly what you wanted to hear, but I hope it helps. Let's see here. Oh, sorry, I already got that one. Let's see here. Anchored view up. Explanation. Okay. Let's do this. I'm going to go back to the SPX where I have that. Okay. Do I have? Yes. Good. Okay. Let's look at the low here. All right. The anchored VWAP, I'm going to highlight it right here. And I want to fill up the screen here with it. All right. So this is anchored. Sorry about that. Okay. So this anchored VWAP right here, it is anchored to the low of 2022. When you have an anchored VWAP, the first portion of it, the anchored part, meaning you need to attach it to a candle. Okay. You can attach it anywhere you want. You can attach it to any time frame you want. I use anchored VWAPs sometimes when I'm day trading or even swing trading. They can be very helpful to find resistance zones, breakouts, etc. You can also go through and change different settings. All right. I won't get into the settings part of it. You can just keep it as it is. But one of the first things okay. Oh, there we go. Okay. You have a lot of options here. You have lots of colors that you can choose from. I said I wasn't going to get into the settings, and I'm not going to. Just know that they are important and they can help you with them. You can set it to the opening high. You can set it to an opening low, like right here, for example. I have mine set to the open. So my anchor is anchored to the opening price of that particular day that I have set the anchored view up to. Okay. You can, again, you have a lot in here to choose from. I'm not going to go through a bunch of them. Have up to 3 different brands here, bands, not brands, bands. So that's that. So number 1, it is anchored. And let's see, do I have this pulled up right here? Let me do this. This may help. What I have over here, real quick, is this. Hold on, let me come over here now. Okay. Oh, come on. I thought this would okay, there we go. All right, so basically I've got the definition here for precisely what the anchored VWAP is. So anchored VWAP, okay? Anchored VWAP displays the volume weighted average price for a specific time period, starting from a user selected point. In other words, anchored VWAP shows the price of an asset adjusted for its volume starting from any point chosen on the chart. So it's an equation using time and volume and price points. Okay. So it can show you support areas, resistance areas as it goes. Example, when I had it set to the opening right here of October 13th, the low of 2022, as we moved up with this, you can see it became an area of support before turning to an area of resistance. And now we are back above it again. Okay. So those who bought in this time frame are in the plus. They are in the positive. They have a gain on their books. Okay. So it can give you an average of the average investor who bought at this moment in time. Are they above water or are they underwater? Okay. It lets you it helps you to understand that aspect as well. Okay. Let me go to a shorter time period. I'm going to clean this up right quick. Let's go to the 5-minute chart. Okay. Let me adjust it right quick. Give me a quick second. It's going to take a moment to get this right. Okay. For example, with today, the anchored VWAP did not come into play, but there is a confluence here with the 20-period moving average and the anchored VWAP where they are coming together, as you can see here, and they will at some point end up acting as a resistance point. Let's go back a little further. Let's use this day where we rallied, where we had the gap down in the morning, and let's place an anchored VWAP, and we're going to put it on the opening candle. And then there, you can see that once we broke above the anchored VWAP, we came back down to back test. We were confirmed, and then we rallied and rallied and rallied to the end of the day, staying above that anchored VWAP. That's one of the purposes for how I use the anchored VWAP on a day-by-day basis, okay? Let me clean this up. All right, let's go back. I'll find one more day. Let's go for a choppy day. For a real choppy day. All right, is this one choppy? And it's kind of angling up. It's a bit choppy. All right, let's do an anchored VWAP on this particular day here. Okay. And again, I'm going to put it on, I'll anchor it to the opening candle of the day right here. Okay. So first thing we see is in the morning, there was a lot of chop, resistance. We broke through. We couldn't hold it. We broke through again. We tried to hold it, but we broke down. Finally, once we broke through it and we were able to stay above it, then we accelerated the rally into the close. So again, this would be another use case for using it on a day-by-day basis. Okay, I see you there. You can see my settings. It's totally fine. I don't mind you seeing my settings at all. If I click on it, oops, I still have the highlighter. Let me remove that highlighter. So once you have your anchored VWAP on the chart, all you got to do is just do a double tap on it. First are your inputs. I only have one band, multiplier number 1, multiplying by 1. My source here is the close of the candle when I'm on the 5-minute chart. When I'm on the daily chart, I move it to the opening candle, and you can see it made a bit of a difference there. The anchored VWAP is now a little bit lower, kind of giving you the same things as we had before, but this time price is a little bit more above than below, even though we're chopping around, but still the same thing. Once we broke above it and we held above it, like not riding on it, but held above it, then we moved higher. Okay. So you can play around with the settings and find which ones work for you. You can go with the high of the candle, the low of the candle. What is this? High, low, 2. And you have some other choices there. So I'm going to put this back on the close, and you'll see that that anchored VWAP changes. Now it's at the top of that opening candle instead of at the bottom. It's a little more flat across the top there. So that's the very first setting. And then you have styles here. You can get into a whole bunch of basically dialing in your anchored VWAP, and you can use a whole bunch of options. Visibility, don't touch anything in here. Leave this as default, as it was. If you want to toy with it, you can create templates in here. That would be my suggestion. Otherwise, leave the visibility tab all by itself. All right. Okay. Let's get out of here and get rid of that. Okay. Let's go back to daily view and get it out of here. All right. Let's see here. What did we miss? Roblox. Yes. I believe that is up next. Can you buy stocks at the of 16? Can you buy stocks at the of 16? Please give me an give me a little more of what you mean there, and we can see. Absolutely got to those settings, and you are very welcome. All right, I don't know what the buy 16 on the stocks means, but anywho, let's get back to this. I'm going to go to Roblox. Roblox has been moving recently, and in the headlines, RBLX is the ticker. I like Roblox for the future, not the future like within a year, but in the future of like 5, 10, 15, 20 years from now. Maybe not even that long, probably somewhere between that 5 and 10 years for Roblox, because technology changes so quick. This is a metaverse play, if you ask me. There's a video I did a while ago, over a year ago, I believe, about the metaverse. Roblox is one of the stocks I mentioned in that video. But if you look here, now's not a good time to invest in Roblox. If we go through a recession, which it looks like we're going to, I mean, the yield curves, they're screaming recession, especially if you look at the 10-year and 3-month. That inversion, that's what the Fed watches. The 2-year and 10-year, that's what the media watches and talks about a lot. But never the case. The inverse, the yield curve inversion that we have, it's screaming recession. Roblox is not going to do good in a recession, okay? People are going to be, looking for their couch money to make sure they have food on the table. It's not a pleasant time for our society to have to go through a recession. It's hard, right? So even though I do like the company, and I do think it is a company for the future, I don't think now is when you want to start investing in a company like Roblox. All right. Let us get through the turbulence, the downside movements we have due to the recession, due to earnings and valuations being so high. Even though when you look at a company like Roblox, yeah, their valuation has dropped significantly, and it should have dropped significantly. We were in an everything bubble, and valuations needed to come down. Apple, that's a company, its valuation has come down, but its valuation has not come down enough. It needs to come down more to match where its earnings are. There's too much of a multiple applied to a company like Apple, okay? And when you think about Apple and its valuation needing to come down, it's going to push valuations of companies like Roblox down even more. And with that said, also look at Apple in the perspective of how many hedge funds, how many ETFs hold Apple. It's a big market cap company. It's got a big reach. It can bring pain to the market, and it will bring pain to the market if earnings do not hold up for the valuation that it has right now. Okay, so kind of big picture on Roblox. One thing that I do like about Roblox, at least on the stock chart here, is we can go back. Let me get the let me get this rectangle out here. We can go back to the top created in March of 22 and basically throw this box around it. And since March of 2022, Roblox has gone nowhere. Okay. So I do like that. It looks like it's trying to base out. It's trying to build a base where it can hold up and hide out until the rotation of our economy can do its thing. All right. Look, if we look at the market cycles and sector rotations, we right now, I believe, are entering stage one. We're probably somewhere right here where we're just starting to enter stage one. Reports are coming in right now, and things are starting to line up, and they're starting to contract, okay? And contraction is a big part of entering phase one or stage one. And when we enter stage one, if you look at the top here, stocks and commodities, they both go down. So there's still more downward pressure to be had on stocks. Look, the stock market peaked right here, okay? And you could call this November, December, January of 21 and entering 22. That's when stocks peaked, and stocks have been declining ever since, right? All right. Well, in stage one, stocks continue to decline. It's not until we start entering stage two that stocks start going back up again. All right. So we need to get into this phase right here. We're not there yet. This may be Q2, Q3, or Q4 of 23 before we get into stage two. And that's the bottom of the economy. All right. Once we do that, then and only then will stocks start going back up. And companies like Roblox can start to enjoy a little more flexibility with their valuation. Okay. Money will start coming back into the market. It'll be a risk on type of environment. the zombie companies, the profitless companies that just are a drag on other companies, they'll be gone. They will have gone bankrupt. They'll be out of the system. The system would have flushed them, and the system would be whole again, with only good companies left standing. Those that have profit, those that have a good balance sheet, those that have good cash flow. Now, in this stage one, what does good? Bonds do good. Look at ticker symbol TLT. Okay? TLT. That is a ticker that I really like for the first half of this year. I wouldn't be putting money into Roblox, even though at least over the past 3 quarters, the stock price has held up pretty well. I mean, we've got a peak around 52, and we've got lows around 22. $30 swing in price. But at least this base out process here seems to be working. But I wouldn't put a ton of money or invest in Roblox at this point in time. Now, I'm not always right. I get things wrong. I'm human. It happens. We can go from one live stream to maybe 2 or 3 live streams later, and maybe a piece of data has come out and I've changed my mind about something. The market isn't static. The market is fluid. At this moment in time, I'm hands off on riskier companies like Roblox. Okay. Roblox could potentially be a good acquisition target, especially if its valuation comes down even more. I mean, look at Microsoft and Activision Blizzard. That was a nice pairing. Will it ultimately go through? I don't know. It looks like there's going to be a challenge here in the US government and maybe even in the EU to that deal. So maybe Facebook, Meta platforms, I should say, maybe they might want Roblox for the metaverse that they are shaping. So that's my thoughts on Roblox. I know I kind of went a little bit macro on that as well. But that's just where we are in this cycle. And I don't think Roblox